G'day everyone and welcome back to this Friday Hidden Gems Share Cafe webinar special. Thanks again for your time. Now, a quick market observation from us, and of course investors always want to know why markets are so volatile, and we all know that the macro picture is deteriorating from both a geopolitical perspective, if we're talking about the Ukraine, but also from an economic one with rising interest rates. But behind the scenes, and what you don't always hear about in the press until it's probably too late, is you'll always find some investment banks' derivatives books are exaggerating market volatility by being short gamma. So a quick lesson on what short gamma is. Effectively, investment banks are short gamma through selling structured products in one form or another to hedge funds and other institutional investors. So what is short gamma? It's where an investment bank sells volatility. They effectively sell options, put options, call options, other structured products to capture the premium associated with selling those options. And effectively, the selling of those options acts like an annuity. So they receive the option premium, and that decays over time. And it's a strategy that works particularly well when markets aren't volatile. And what happens is this strategy works well for a long time, and then the strategy can blow up really quickly when markets implode. And the implication is that short volatility means traders' books, their trading books, are in reverse to the market's movements. So when markets fall, they get shorter, and as markets rise, they're getting longer. So effectively, being in that sort of position is difficult for trading books. And the GFC, this was an extreme example. We saw investment banks close down because of these trading positions. And it's not a position that you can turn around quickly, as these trading books are forced to buy back volatility at higher prices. And if you think about the moves we've seen in the markets the last couple of days, where you've got an up 3% and a down 3%, these trading books would be getting killed at present. So if it continues, watch out for headlines about investment banks losing a bomb inside their trading books. So that's the lesson for today. Don't be afraid to ask questions of the presenters we're about to introduce. Type your questions in the Q&A box provided. Okay, first up, we have Abx Group, ASX code, ABX of course, market cap of around $42 million, a one-year return of up 46%. The company is an exploration, development and production company currently developing a range of rare earth element projects in Tasmania, Queensland and New South Wales. We have with us Dr. Mark Cooksey, who is the CEO. Mark, over to you. Thank you.
Great. Thank you, Tim. So Australia relies on imports for many chemicals, and we'd suffer enormously if those supplies were cut off for any reason. So I'm Mark Cooksey. I've got 20 years experience in innovation in the minerals sector, mostly with Rio Tinto and CSIRO, and I joined ABX 2 years ago. And if there's one thing I'd like you to remember from this presentation, it's that Abx Group is judiciously investing in a small number of opportunities to increase the supplies of strategic minerals and chemicals. Okay. Next slide. So that's our standard disclaimer, and then our corporate overview. You'll see the share price over the last couple of months has increased from 10 to 14 cents and then to 18 cents, 18, 19 cents more recently. And that's really pretty clearly on the back of our rare earth announcements. Next slide. So, as I said, Abx Group, we're creating new sources and technologies for the supply of strategic minerals and chemicals. And we've got three areas. One is rare earth exploration. The second is the technology for the production of aluminium fluoride, a strategic chemical. And the third is bauxite exploration and mining. And I'm just going to describe the first two of these today. Next slide. So rare earth discoveries. Next slide. So you may know that rare earth elements have many applications. Demand's growing rapidly, especially for things like electric vehicles and wind turbines. China dominates the markets, from mining right through processing and even to the applications. And the prices of different rare earths can vary enormously, even by a factor of 1,000. And that's because you mine a certain mix of rare earths in the ground, and the demand is a certain mix depending on the application, and those mixes don't match. So ones rare earths that are in deficit are very high priced, ones that are in surplus are much lower priced. And they're very difficult to substitute. Just because one's higher priced, you can't easily then substitute it with a lower price rare earth. Next slide. So most rare earths come from what are called hard rock deposits. And that's certainly all of the ones produced in Australia and even in China. And they're fine, they're good, good grades. But the one thing is that because the rare earths are bonded in the mineral, requires quite complex and therefore expensive processing to extract the rare earths. Another type of rare earth deposit is what's called an ionic absorption clay. So this is where it's actually a clay deposit where rare earth elements and compounds have been absorbed to the clay. These are currently only mined in southern China. There's people like us looking around the world. And these deposits contain a much higher proportion of the higher value rare earths, particularly the ones for the permanent magnets, which is the largest market by value for rare earths and the fastest growing. And so on the left there is a graph showing that a good hard rock deposit has a high proportion of the lanthanum and cerium, which is relatively low value, whereas an ionic clay on the right has a much higher proportion of the two green pieces of pie, the higher value heavy rare earths. And also because the processing is easier, generally, there's lower processing costs and also a shorter time to get into production. Next slide. So Abx, we are looking for rare earths, particularly in Tasmania, and we are the first company to discover rare earths in Tasmania. And this is built on the back of our previous bauxite exploration and mining efforts. And the results, I mean, it is relatively early days, but they look very promising. So we're seeing good grades. They appear to be the ionic type. So the mix of rare earths that we're seeing is very similar to the previous slide showing, basically a high proportion of the heavy rare earths. And also clearly the ground is clearly a clay. So the evidence is that it's an ionic clay, but we still need to confirm that. It's at fairly shallow depth and also very low levels of thorium and uranium. And, it's covering a pretty wide range. So that is sort of up around Launceston. We've got results over a 50-kilometre range. So it's quite exciting. Okay, next slide. So our strategy is to rapidly develop low-cost production of a rare earth concentrate. And because it appears to be this ionic clay type, we think that's feasible. So we're currently doing metallurgical testing. This is with an external laboratory to determine what percentage of the rare earth can be recovered from the ore. That's another good way of determining whether it's this ionic clay type. We're doing further drilling campaigns. In fact, one's happening right now. The team's been there for a couple of weeks and we'll be there for another month or two to expand our results. And we're also looking at improving our exploration capabilities to identify even further rare earth deposits. So it's quite an exciting time. We want to move quickly to capture the opportunity in this market. Okay, next slide. So now on to the second area for Abx. It's quite different. It's a subsidiary that we own, 83% own, called Alcor, for the production of aluminium fluoride. Next slide. So aluminium fluoride is a chemical. It's essential for aluminium smelting. So without it, your smelter within a couple of weeks would be in real trouble, almost to the risk, really to the risk of shutdown. There's over 1 million tonnes produced a year. It's over a US $1 billion market. Australia is the largest aluminium producing region in the world without its own local supply. So we rely entirely on imports and most of it comes from China. So China is basically self-sufficient. They produce a small amount of excess and we're the biggest importers of that. It's a relatively high cost material. The reason it's over US $1,000 a tonne, in fact, it's $1,800 a tonne at the moment, is that the fluorine, you need to get that from fluorite. And there's not that much high grade fluorite around, and that's leading to relatively high costs. So the opportunity is, well, is there a better source of fluorine? Now, coincidentally, the aluminium industry produces it's called an aluminium smelter bath waste, which is very high in fluorine. Now, for decades, that material has been sold to new smelters that are being constructed. In the last 5 years or so, and it's only going to get worse, is there's not enough new smelters being constructed. And so this material is now at risk of becoming a waste that smelters have to stockpile. So what we have is, in Australia, a need for aluminium fluoride, and all the smelters are producing a fluorine heavy waste that they don't know what to do with. Next slide. So what Alcor is doing is a process to turn that aluminium smelter bath into aluminium fluoride. So we've developed processes to get the fluorine out of the bath, and also to make the material even cheaper, we're looking at lower cost sources of aluminium. And one of those is called dross. It's another waste from the aluminium smelting process, and also bauxite, which is a relatively low cost source of aluminium. So this is just a perfect illustration of the circular economy. We take the waste out of the smelter, we turn it back into a material that the smelter needs. Next slide. So looking at the economics, so this is based on long-term historical prices, exchange rates, etc., and our best estimated costs for a 20,000 tonne per year plant, which is our planned ultimate plant size. And there's some different scenarios there depending on what raw material we use for the aluminium, whether I'm being conservative or optimistic with prices, but really it's attractive under all scenarios. And that's because the bath can be attained at very low cost. And also, not only do we produce aluminium fluoride, we produce a couple of other co-products that are industrial chemicals. And so there's some revenue from that as well. Next slide. So where we're up to is we have demonstrated the process in the laboratory. We can get the fluorine out of the bath. We can make aluminium fluoride that's basically the same as existing aluminium fluoride. So we're now moving to the pilot plant stage. A couple of pictures shown there, where we need to do this, say, at 10 kilograms an hour to demonstrate the process in order to scale it up to commercial. Next slide. And so our plan is to, say there's the second box there is our pilot plant stage, which is being done at our same research facility on the New South Wales Central Coast. The next stage is a small commercial plant planned for Bell Bay in Tasmania, near the existing aluminium smelter. That'll produce 1,300 tonnes a year of aluminium fluoride. That's just a proportion of the Australian market. But it's the right combination of a suitable amount of scale up, but also positive cash flow. Estimated capital cost of $16 million. And a week ago, the federal government announced that we'd received a $7.5 million grant to support that project. So it was fantastic. We're very grateful for that. And then the plan from that, once we prove it at that scale, is then to multiply by 15 to a larger plant, 20,000 tonnes a year of aluminium fluoride, which will supply basically the Australian market. Thereafter, you could go overseas and you would build other plants in major aluminium producing regions around the world, such as Quebec or the Middle East. Next slide. So thank you for listening. And so, yeah, our two big areas, rare earth exploration in northern Tasmania and new technology for the production of aluminium fluoride, an essential chemical for aluminium smelting. Thanks for listening.
Thanks, Mark. Just starting with rare earths, and I note that you said that you got low radioactive elements in your samples there. Generally defined rare earths, you have to have that radioactive element to actually have tools to help find them. So how do you discover these kind of rare earth elements without that radioactive?
Yeah, so I think the ionic clays are different. And so, in fact, Ian Levy, our previous CEO, steel director and head geologist, he had the theory that there could, based on his experience and knowledge and networks, that there could be some rare earths that formed in a similar manner to the bauxites. And so it was actually looking around our bauxite that led to our discoveries of the rare earths.
Makes sense. And do you expect to see some sort of government funding at some stage in this part of your business?
Definitely. I think we've seen there's been many grants given out to rare earth companies at different stages, and we'll be absolutely seeking those, and I think we'd have a good chance of success. We're just not quite at that point. I think later this year, once we have probably in a few months, when we have our latest drilling results and some metallurgical results, that'll be the point where we'd start seeking government support, and the government's being very proactive about this area at the moment.
And in regards to aluminium, do you have any support from some of the aluminium companies out there?
Yeah, for sure. So we're working closely with so the two big companies in Australia are Rio Tinto and Alcoa. We talk to them regularly. You know, my background's originally in that industry, and also with the global companies. I've got the global companies actually, I know them from previous roles, actually approaching me saying, Mark, we've got this problem with our smelter bath. What are we going to do with it? We know you're working on a solution. How can we help you? So that's very exciting, and it actually means, that's very exciting.
And are there any competitors in this space for Alcor?
No, not really. It's quite interesting because, the aluminium fluoride, it's just a nice little industry. The people that are currently producing it rely on a good source of fluorite. And so when they see bath, they just see that as something completely different and not something they're geared up to do. And the aluminium companies, although they want a solution, they really want someone else to come up with a solution and for them to support it. They don't want to get into it themselves. So I've seen, maybe a couple of university papers elsewhere, but we're the only people doing this seriously.
And how confident are you that you'll be able to kind of commercialise your technology?
Yeah, well, confident. At CSIRO, I was involved in the development of a lot of similar technologies, and there's always something that can hurt you. The market's hard to beat, or there's not enough supply of the raw material. This one, I think, has the highest chance of success of any I've been involved in because it's a very stable market, very predictable. We know this raw material will be available for decades. And we believe at low costs because it's only going to grow as a waste. And we've got a good technology and there's barely anyone else looking at it. So it's very satisfying from that point of view.
And what can shareholders look towards over the next 12 months or so, just as we finish up?
So this year we've got on rare earths, there's more drilling results, metallurgical results, and on Alcor, it is construction and operation and the performance of the pilot plant and engagements with the aluminium companies.
Mark, thanks for your time. That's all we have time for. Love to get you back on later in the year.
Great. Thank you, Tim.
Have a nice weekend.
Thank you.
Next up, we have Webcentral, ASX code WCG, market cap around 94 million. Has only been listed in the last 12 months. The company operates as a licensed telecommunications carrier in Australia and New Zealand. The company offers data connectivity, cloud and data center and managed services. We have with us, I don't know, Joe, whether you're up next. I think we have Matt Gauci up next.
No, it's me.
It is you, Joe, is it?
Yep.
Apologies. We've made a mess of the introduction, so I'll pass over to you. Thank you.
No worries. Thanks, Tim. Hello, everyone. Webcentral is, I guess it's a combination, a merger of 5G Networks, which is a licensed telco that owns and operates infrastructure across Australia, data centres, fibre networks, and its own private cloud. And we also service a lot of corporate clients, around 12 offices with 90-odd field techs who go out and do sort of break fix for IT work. And so that listed in 2017. And then Webcentral, which a lot of people might know, the old Melbourne IT, Webcentral's been around for quite a while and had a few iterations. We took control of Webcentral in October 2000. And since then, we've done a merger of the two businesses. If we can just go to the next couple of slides. Yep, thank you. So basically two components to the business. The Webcentral part of the business is 330,000 customers. We manage over 500,000 domain names across, I guess it's that SME marketplace, mums and dads businesses. We provide email services. We provide website hosting. We do some digital marketing. And then the enterprise part of our business, which is the 5G networks part, we're servicing, high-end clients, like we host McDonald's website, and Event is one of our clients, Fairfax. So we service a number of governments, state government clients, some of those high-end enterprise clients, and then also we resell our services to wholesale managed service providers, and then end user corporates. So they're sort of the segments, the two parts of the business. So cloud is just traditional cloud hosting, whether that's hosting applications or websites. Domain names, as everyone knows, your .com, .au or .net.au or .com. Managed services is, as I said, the 90 techs around the country who go out and fix IT, install equipment, provision laptops and servers and networking equipment on site, or we also service those customers remotely. We have our own fibre network, about over 100 kilometres of fibre. We connect about 50 data centres across Australia, and we sell those services, whether that's a dark fibre service or a managed service. We've got 5 data centres across Australia, so one in Adelaide, 2 in Sydney, 1 in Melbourne, and 1 in Brisbane. And we also sell hardware and software that goes with that, and some project work. Profitable business. This financial year, we've given guidance in the range of 17 to 18.5 million EBITDA on revenue of just around 100 million. There's a little bit of delay or impact from supply chain issues with getting hardware delivered and the timing of that. So there's, at the moment, we've probably got, we're down on revenue by about $1 or $2 million, which is just waiting on the delivery of the hardware before we can invoice for that. But if you look at our exiting EBITDA run rate for March was 1.5 million, and our net operating cash flows 1.2. We've got some leases that we're exiting over the next couple of months, which will save us another couple of $100,000 a month. So really strong business, strong profitability, real annuity base. So with that sort of mix of customers, across various products, it's really steady annuity-based business. So it's performing well. We've got some growth areas. So if we just go to the next slide. So some of the, as I said, they're the guidance and the revenue and run rate, just reiterating those, strong cash flow. Some of the new exciting things that are happening in our marketplace is the launch of .au. So you can, you don't need webcentral.com.au anymore. You can just have webcentral.au, and I'll talk a little bit more about that in a minute and the benefits of that. As I said, we've got over 500,000 domains. That generates about 22 million of revenue. So the launch of the .au is really growing that same market. We expect customers to buy both domains and keep both domains. And then we're expecting that we're targeting internally around 150,000 .au domains, over the next 12 months. We've already surpassed 18,000. We've done a cleanup of our share registry through the merger of the two businesses, and we've removed we've 16,000 shareholders. We've reduced that down to 11,000 now. So that'll clean up some of the selling, and the board is just reviewing our capital management policies around potential share buyback and dividend policy. We'll talk a little bit more about that in the future. Over the 5 years that we've been listed, we've done 12 acquisitions. We've got one in play at the moment. We own 18% of Cirrus Networks, which is a more high-end federal government, state government, mining focused managed service provider. They sell a lot of hardware and install those solutions, but they don't have the infrastructure or add the value that we do. So we think that's a target. We did an on-market takeover last year, but we're unsuccessful to gain board control. So we're just evaluating that investment. Let's go to the next slide, please. So what's the benefits of the .au domain? Certainly, if you're a corporate business out there and you want to maintain your trademark or your brand, you don't want, if you're bellpotter.com.au, you don't want someone launching a website of bellpotter.au and then trying to sell corporate advisory or brokering type services. So there's real benefit in protecting your brand and your trademark. The federal government's come out and said that it's actually now important from a security perspective. So again, we've all seen people, try and spoof your email account. So it would be quite easy if we drop the .com out of an email address and just had the .au. It'd be difficult to notice if the rest of the website, the email address, looked very similar. And certainly something that Webcentral is taking advantage of at the moment in supporting the .au launch. We dropped the .com out of our domain name, and so we're just webcentral.au. But what we found is that our search or our organic search, where Google rank you on a search. So if someone's buying a domain name and they're searching, Domain Names Australia, then we would normally rank on the first page for that. We've seen a reduction in where we were ranking and lost a whole lot of rankings by changing the .au. Now what we've seen after just 3 weeks is that we're now ranking above our competitors. So Google will rank or give more credence to any Australian company. If someone's doing a search for an Australian product in Australia, and they can tell that from your IP address, and you've got the domain name .au, then you will rank above your competitors .com.au every time. So, for us, that's fantastic. Our largest competitors are GoDaddy and Crazy Domain, and they spend, significantly more on digital marketing than we do and have a lot larger budgets. But we're now seeing that we're ranking above those competitors because we've changed to the shorter .au domain. So certainly if you're, an Australian business, it's a handy tip to go and grab the .au and get it changed and migrate it over so that you'll benefit from those organic searches and you're not having to pay so much. We've also seen a reduction in our cost or our spend with Google for the digital marketing. So there's 3 benefits of why you'd want to adopt the .au and move across to that. As I said before, we also have the Melbourne IT brand. The Melbourne IT brand is more of a high-end business customer, we provide different support for those services, but generally it's priced sort of 3 to 4 times higher than the Webcentral products. But it is a different level of support for more corporate-related clients. Next slide, please. So just to reiterate around our infrastructure, and I guess we're a domain hosting email company to consumers, but we're also backed by a telco. So we've got our own infrastructure. We have plenty of capacity, direct capacity into LA, Tokyo, Singapore, New Zealand, and high-speed 100 gig links into every capital city in Australia. And we host our clients' websites in, if you're a Perth business, then we host your website in Perth, and we provide high-speed access to that website for the best quality and redundancy. So we're not a backyard web hosting organisation, which some of our competitors are, or they use international providers and might host the websites in Singapore or somewhere else. So next slide, please. This is just a forward-looking forecast of where we think we're going. So through the journey of our business, we've been able to not only grow revenue, but grow our EBITDA percentage. And again, for FY23, we're looking to, get to around that 23% EBITDA margin on revenue of about 120 million. As I said, we've got a number of direct products that we're launching. We've been able to improve our hosting sales since we've acquired the business. So normally we would host about 8% of our domain names. We're now seeing an increase of that to 25%. So we expect to real increase in revenue from our hosting. Obviously, the launch of the .au, as I've shown, some of the numbers and where that we think that can grow to, and then some of our corporate products, our CloudPort product, we're launching, and that's going quite well. We're selling dark fiber, as I said, into our data centers around Australia, and that's we just see demand constantly growing for that. Microsoft have said to be spending, building another 100 data centers worldwide, over the next couple of years. So certainly significant demand for cloud capacity and connections into those DCs. Next slide, please. So if I just, we've provided this guidance a little while ago to the market as to where we're going. So there's 6 monthly targets. We're launching our NBN product. Again, we're a telco. We've got plenty of telco capacity. We've got our automated billing systems, and we also provide support for our hosting domains and emails. So to bolt on an NBN product just fits nicely with the solutions and services that we offer our clients, and we expect to see a sort of 22% margin on our NBN services. And then we've got some organic growth that's coming through. We've done some realignment of products, and therefore we've been able to increase some of our margins on some of our core products, which is driving some of that organic growth. We just go to the EBITDA, the next slide. So you can see there's, like I said, we're between that 17 to 18.5 million EBITDA for this financial year, and rising up to 28, around the 28 million EBITDA for the following year. So at the moment we're sitting on a multiple of about 5 times, which is really quite cheap in the telco sector. Next slide, please. And as I said, the exited run rate for March was 1.2 million of free cash flow. A lot of our CapEx spend is now reducing as well. We spent a lot of money, about $6 million, on building out our fibre network in Melbourne, Sydney, Brisbane, and Adelaide, and expanding our infrastructure capacity to bring on some of these new products as well. So we expect that to drop off. So we'll see a lot of cash flowing through to the business, and that's why we're looking at what we do around dividends or share buybacks. It's certainly at our current valuation. Next slide, please. That's it. Thank you, Tim. Thank you, everyone.
Thanks, Joe, and apologies for that introduction. You'll be pleased to know that we are a client, Joe, across our domain names.
We need to get your .au so you can.
Well, I was looking at that before we did our homework. So, I mean, why would we do that? Is that more to protect the brand as these domain names move into that .au? And
yeah, so there's a trademark protection there, absolutely. I mean, obviously you've got some other legal, people. You can't actually. You've got a 6-month period where if you've got the .com.au, then you've got first entitlement to the .au. Gotcha. From the 23rd of September, it's a free for all. So anyone can go and register a .au if that .com.au guy hasn't claimed his .au. So you've got a bit of a window. So there's brand protection. As I said, there's security related protection. So again, you wouldn't want someone registering the domain and then start sending emails to your finance people to start, paying suppliers, and all they've done is dropped out the .com in that email address. So it's quite hard to recognise. And then the third one is, quite frankly, it's a free kick, especially if you've got US competitors like us who may not be onto the change as fast as we have been. That organic ranking, especially if you're a digital business, if you rely on leads coming from that Google search, then you'd be jumping on this straight away. It's the first category or the box they look for is the domain name. Doesn't matter what you're doing with meta tags and content and writing blogs and all that sort of stuff. If you've got that .au, you'll rank above your competitors that are on the .com.au.
Like you said, that's a good annuity business for you. We'll go and do it. It does make a difference to our bottom line, and it's a great business. In regards to your product suite, where do you get your highest margins?
Yeah, so all the and again with our acquisitions, and where we're trying to grow the business. It's not anything that's on our infrastructure. So think of cloud hosting, 80, 90 points of margin, incremental margin for any new customer we put on there. On our fiber network, it's the same 80, 90 points. Data centers are around that filling up our data centers about 70 points of margin. Managed IT, that's a labor sort of business. So you sort of 30 to 35 points of margin. Hardware and software is about 10 to 12. So, that's how we focus the business. And when we either look at organic growth or acquisitions, we're targeting those high margin areas or businesses that are going to deliver us those high margins.
And to close this kind of valuation gap that you've perceived compared to your competitors in the telco space, what's your preference between dividends and share buybacks, and what sort of payout ratio may you consider?
Yeah, look, I'm, probably a selfish view. I've got 16% of the company, so I'm certainly chasing dividends. And I think it rewards all shareholders, right? I mean,
yep.
I love the Dicker data model. He pays his staff in his senior staff in dividends, and he just doesn't take a wage and takes a dividend. So I think, there's some of the brokers come back from the US, and some organisations over there are paying quarterly dividends. So, I think there's a bit of space to be played in that. Look, we'll definitely pay a dividend. I'm not sure the size. A 1 cent dividend, for example, is, only $3 million. So a bit over $3 million. So, we've got some capacity there to start looking at that, and we might be a bit creative around how we do that.
Great, Joe. That's all we have time for. Really interesting story. We're a client. We like your work. Thanks again.
Thanks very much. Cheers.
Next up, we have Propel, ASX code PHL, market cap of around 6.5 million. The company is a fintech company providing intelligent finance solutions to small, medium enterprises, SMEs. We have with us Michael Davidson, who is the managing director. Michael, over to you. Thank you.
Thanks, Tim. Hi, everyone. Thanks for joining. So first question I get asked is who is Propel? We're the only multi-product financial services platform targeted exclusively at addressing all the finance needs of an Australian small business. And we do it in one simple app. And importantly, we've built our entire platform in-house, allowing us to continue to deliver innovations to our customers and be first to market with those advancements. Now, I'll take you quickly through to some company highlights. Sorry, next slide. A couple through. That was supposed to be on that one. I did miss that. Next slide, please. Through to some of those highlights. As I mentioned, we've been in market for more than 2 years with now proven technology. We're operating in a huge market. There's millions of customers, small businesses in Australia, and with hundreds of billions in loans to those small businesses. And we're demonstrating traction, growing the customer base by more than 30% quarter on quarter. And that's for the last 5 quarters. We've grown from about 300 customers at IPO 12 months ago to more than 1,700 now, and are on a path to end at about 3,500 by the end of the year. We're putting in place partnerships with leading fintechs like Square, Stripe, and Zip to accelerate that growth. And we've invested significant time and resource developing a technologically sophisticated platform that gives our customers a highly automated, 100% digital and personalized experience. It also allows us to launch those new products quickly and cost effectively, and is very difficult to replicate for those reasons. And for those reasons, we have a clear path to profitability through scale of both customers and product sales. I'll now quickly take you through, next slide, some of the pain points our customers experience and then how we address it. So you see here, we spend a lot of time speaking to small businesses and have a number of examples of really common pain points. Now, what is often understood is that operating a small business is difficult, but there are a number of really specific challenges the majority face. They lack financial knowledge. They're very good at what they do, but very rarely does that extend to finance. And they don't have in-house financial capability. They don't have a CFO or finance team to guide them. They're time poor. They generally have 1 or 2 owners who are really stretched just operating the business. And when they do know what they want, what products they're looking for, they struggle to get it. Banks have historically viewed them as high risk and hard to deal with, leaving them with very little access to small business specific product. And because of this, they're forced to cobble together a range of solutions from disconnected services, even using personal bank accounts, cards, and products to manage their finances. And that makes it really difficult to operate, causing a lot of headaches, but also very difficult to unpick at tax time. Now, Propel addresses this by bringing all those solutions together in one place with really simple and fast access they can't get elsewhere. Next slide. Now, just quickly show you through. We give our customers, as I mentioned, access to those products and services that are critical to their operation, and it falls under a few categories. There's financing, so essentially access to capital to operate and grow. Payment acceptance, the ability to accept a wide range of payments and get funds in their account quickly. And insights, and it's something they don't get anywhere else, and that's a view into the financial health of their business, both their credit insights of the owners and the business, but also a detailed breakdown of how funds move through the business. And in the very near future, we're about to launch a small business bank account and card, and that'll allow them to centralize all their finances on Propel and leave that outdated bank service behind. And we can do it all at scale because of due to essentially the high level of automation we've engineered into our platform, which also delivers a number of benefits that are impossible to replicate without this technology in place, including delivering that highly personalized experience. Every customer gets a personalized experience on Propel. We're able to onboard and serve a really high number of customers with very few operational staff. And we're able to do it in one app that allows us to capture really extensive data about those customers to guide the development of our business. Next slide. Now, just back to the pain points and the specific products on our platform that address those needs. So on the insight piece, you see deep insights into their credit, cash flow and finances. On the financing side, we have 6 and 12-month lines of credit, but we're in the near future launching equipment asset finance and also invoice financing, easy for me to say. Payment side, we have a full suite of payment tools, which serve the bulk of the needs of a small business. And as I mentioned earlier, that small account and card is going to be launched in this calendar year. Next slide. Now, how does that all come together for a customer? What's the experience? So we have an example here. This is Jane. She runs a small plumbing business, just won a big contract and needs funds to be able to fulfill that. Now, she finds us online and can sign up in 5 minutes. And it is entirely online, that journey, with no additional paperwork. At the completion of that 5-minute application, we've done a full assessment, or our platform's done a full assessment of her and her business. And we're able to offer conditional approval for funding with funds available the same day. So she's solving that burning need very fast. But this is just the start of the relationship. We continue staying in touch with Jane. Her funding facility remains active and can be drawn at any time. But we also stay connected to all of the data about Jane and her business and the financial information that allows us to give ongoing insights, but also the insights we gain from that data allows us to help Jane by placing relevant products in front, solve more of her problems, and essentially drive more revenue for Propel. Now, it's important to note as well that this is how the majority of customers come to us. They're not looking for a platform. They have a burning problem, whether it's funding, insights, or payments. They join the platform and then we're able to, and they realize they can solve more, if not all of their needs. Next slide. And I'll actually get you to jump down too, because I'll now talk about the opportunity and the market. Now, when considering the opportunity, it's important to consider the size. Propel's focus, as I mentioned earlier, on a huge market. There's 2.3 million small businesses in Australia. Now, whilst we initially focused on that entire segment, we've come to refine it further to businesses with turnover between 120,000 to 5 million, and there's more than 1.25 in that segment. Now, it's also worthwhile noting the size of this segment globally is enormous. There's 55 million in key Western markets, US, UK, and Europe, and more than 300 million globally. And I mention it, not just as a throwaway comment, but because from our research and what we've seen, that the issues that our small businesses face are reflected very accurately and similarly in those international markets. And we've architected our platform in such a way that we're able to drop it into another market with very little technical development. Next slide. Now, the second piece of understanding the competitive landscape is to look at the characteristics of the business. Now, first, we look at the type of business. Are they small and simple through to large and complex, and think small to enterprise corporate? And the second axis is you look at how they're servicing their needs or how they want to service their needs, and whether that's a bunch of single category products right through to a comprehensive solution. Now, we've found, and they've spoken really clearly, that our segment of the market want a single comprehensive solution to solve the need for the reasons I mentioned earlier, that they're time poor and struggle to solve it elsewhere. And they rank actually speed and accessibility above all other measures, including price, amazingly. So it's less about a race to the bottom on a price and competing there. It's more about what can I solve? Now, next slide. I think you'll need to jump down too, because we'll go to, the divider slide. And I'll take you through the progress we've made to date. We've seen significant growth across the areas of customers, product and process. As mentioned earlier, we've grown to 1,700 at more than 30% a quarter. We've grown our lending even faster at more than 200% last quarter on quarter and at really attractive margins. We're broadening those acquisition channels, as I mentioned, to further boost growth and rapidly growing the number of products on the platform. With a number of launches since IPO, it allows us to sell more product into those customers with essentially zero incremental cost whilst driving more revenue. And we have, as you've seen, a really strong pipeline of developments that are coming. We've also, and the final piece that's really important, is we've been able to drive down substantially the cost to acquire each new customer over the past year and continuing to work on it. And that allows it both through developing digital marketing strategies, but also with the highly automated nature of the platform, we're able to scale customers 24/7, 365 days a year quickly without headcount. Next slide. I'll speak quickly about the revenue model because it's often people want to understand. It's very straightforward and well understood. We have direct revenues coming from our lending products and lending margin. And on the payment side, we get a percentage of the transaction revenue. Now, importantly, these revenue lines grow with each new product that we launch. And we're also aiming to add a SaaS-based premium platform subscription to the product by the end of the year. Now, next slide, please. And actually, again, jump down too, because we'll go to the future strategy. So I guess where to from here? Now, we're focused on continuing to drive growth in those same areas. So continuing organic growth, but also boosting that with the partnerships that I mentioned. We'll continue to add in-demand products, further developing, it actually builds out the usefulness of the platform with our customers and in turn makes them more sticky, but very focused on delivering on the high margin lending products and that small business account and card. Whilst continuing to refine the platform, even though we've done the bulk of the work of building out our platform, we're always aiming for further automation that allows us to scale. But importantly, you're only able to deliver this type of specialized and personalized service with that technology in place and allows us to cross-sell more. And we're targeting getting to 100,000 small businesses in 5 years. So I'll just go down again, next slide. Just to sum up, our view of Propel, we're operating in a massive market now with proven demand and growth. We're uniquely positioned in that underserved market as the sole provider of this all-in-one finance app for small business. And we're realizing the benefits now of the investments we've made to date in the platform, allowing rapid growth of customer numbers, products, and partnerships. And we have a successful track record of delivering on what we said we would do at IPO, both on KPIs and on product rollout. And finally, have a clear strategy for this next stage. So strategy for product and roadmap to take us through the next part of our journey. Thanks, Tim. I'll hand back to you.
Thanks, Michael. Just a couple of questions. I suppose the question is, what's the sales process and how do you get access to these SMEs, given they are small business owners that are really busy?
Yeah, no. The fantastic thing about our customers, and it lines up with digital marketing, which is also very accurate, is that the type of business that is looking for a solution that's fast is generally doing it online. So we have focused our marketing strategies on digital to date, and we really drove it almost exclusively through SEO, SEM, search engine marketing, search engine optimization, and social. We are finding now, though, as we're reaching this scale, that we're broadening that out to more marketing strategies with a one-to-many through those partnerships with groups that operate with small businesses, but also starting to do some offline activity as we hit this next stage. And I suppose all your products, correct me if I'm wrong, are focused on financing and lending, and obviously that's how you get paid. What about helping SMEs get paid? I know you highlighted a plumber there. They're always struggling to chase invoices and things like that. Are there other products you're going to offer on the platform? Yeah, well, the payments component of our platform pretty much covers every payment need that they could have. It's from the payment type. So if we think Visa, MasterCard, Amex, buy now, pay laters, those types of payments, they're able to accept all of those, specifically in BNPL, Zip, Afterpay. And then on how they get paid, they can take it in person with a terminal, they can take it online, over the phone, So yeah, in the getting paid, and that is really important component of this, is don't just throw another loan at a problem when you can actually do it more effectively and efficiently by getting paid sooner. But we find it's generally a combination that a business will use.
And is your competitive advantage here in the actual technology?
100% it is. So the trend and what the customers are saying, they're just screaming, it just has to be fast. And if you look at traditional processes, I mean, I should put it as number one, but no paperwork is actually probably the most important piece. We're able to capture all of their information digitally, do a full assessment, and keep that assessment live moving forward. So we're able to understand their health and understand what they need, but they're not having to send in a business plan, find their forms, take it into a branch and do the whole process. Ours is 5 minutes and funding in a day versus days and weeks with the other options. And that's why we're getting this traction.
And how does that work? If I went to a bank, I'd have to fill out similar forms, wouldn't I, that you're producing that go to the bank regardless?
Yeah, you do. But often, and where it becomes difficult, specifically with the banks, and we've seen this ourselves, that if you're talking about an individual product, they will go and apply for a product. And yes, it's usually a much more laborious process with paperwork included. But additionally, they say, okay, I now want a payment service. Oh, that's another department. You've got to go fill out that form again. So it's not only is it simple in its first go, but we also pre-originate. So if we land when we land equipment finance in the coming months, we'll be going out to our base with a pre-originated, you are approved for equipment finance, click this button and away you go. Not, hey, you now need to sign up again. And that is just a step change in the experience that they're getting from their traditional providers.
And how will the kind of integration with Xero and all those sort of things work? It just becomes kind of end-to-end solution?
Yeah, no, very much. And the platform has been architected. So we already work with partners and we have integrations, and we work with Stripe on the payment side. We work with a number of payment providers. So the platform's built not only to be, and we probably don't explain it enough, what the customer sees is really just the tip of the iceberg. It's what we've built into the platform that is technically quite difficult to build and therefore really hard to replicate, that allows us to not only add our own products more quickly, but when we work with a partner, we have a really solid set of APIs built out that is also very easy for them to plug in. So integrations with, and we're working through getting Xero and the accounting packages plugged in for a number of reasons. But it's a relatively straightforward technical process. It actually really comes down to more operationally. We're very focused on what the experience is for that customer and essentially propellifying it. Like, how do we make sure that it really fits with super fast, super simple, very easy to understand, and delivers what they need when they need it.
And the business model is kind of focused on taking a small margin from all these different providers, I assume. Is there a plan to have like
correct,
a subscription model for the actual SME?
Yeah, so I mentioned earlier, we're working on that now, what that will look like. The lending is the high margin part of the business. So we are focused on bringing on a lot of that, and it's very high margin in comparison. But equally, as the platform has achieved much more usefulness, we're looking at bringing on a SaaS subscription, essentially a premium subscription that the businesses will get deeper insights into their financials. And we can essentially help them more with that, but also importantly, access to product and better pricing. And we're expecting that in the second half of this calendar year.
Great, Michael. That's all we have time for. Have a nice weekend. Love to hear the Propel story later in the year.
Brilliant. Thanks, Tim.
Okay, next up we have Lithium Australia, ASX code LIT, market cap around $98 million, 1 year return of -24%. The company engages in the acquisition, exploration and development of lithium properties. The company plans to create a circular battery economy, improving resource security in the process. We welcome back the Managing Director, Adrian Griffin. Adrian, over to you, mate.
Thanks very much, Tim. Next slide, please. And the next one. And there you go.
Lithium-ion batteries power billions of devices, headphones, cameras, laptops, e-bikes, almost anything you don't need a cord for. But all those combined are a drop in the ocean compared to what electric vehicles need. which is why demand for lithium is predicted to outstrip supply by 2025. Other critical materials like cobalt are sourced from countries that don't care about the environment, don't care about human rights, and don't care about corruption, leading to ethical and supply chain issues. Lithium Australia is researching lithium ferrophosphate, a type of lithium-ion battery that doesn't require commodities from conflict zones. LFP is also safer, cheaper, and more efficient, and operates over a wider range of temperatures. Lithium Australia's proprietary processes offer a seamless pathway from the mining and refining of raw materials through to battery production, and finally, the recycling of spent batteries to create new ones, ensuring a more sustainable industry. Lithium Australia controls 4 distinct business divisions. The Raw Materials Division, which has investments in listed lithium explorers and equity ownership in lithium projects. The Lithium Chemicals Division, which has developed 2 novel processes, Silage and Lena, to improve the viability of existing mining operations and enhance energy security where conventional resources are scarce or non-existent. Silage extracts lithium from mine waste to deliver inexpensive lithium with a low energy footprint. Lena utilises fine or low-grade spodumene currently discarded by conventional lithium concentrate producers, which renders existing ore reserves more economical. The Batteries Division, which includes a pilot plant and lab-scale production and testing facilities that specialise in battery cathode materials, primarily LFP. Numerous patent applications are pending, and the nanotechnology has been awarded significant research grants by the Australian government. LFP is the fastest growing sector of the lithium-ion battery market, and with only 2% currently produced outside China, alternative sources will quickly become critical in securing a diverse global energy supply. And lastly, the Recycling Division, which collects, sorts and shreds spent batteries to recover critical materials for new battery production. With these 4 divisions, Lithium Australia leads the world in securing an ethical, secure and sustainable battery industry.
Okay, next please. From that, you can probably gather that the company has a suite of technologies, one that dovetails into each other, one after the other, and as a consequence provides a complete ESG solution for the battery industry, starting off with low energy extraction technologies, going into the production of high specification battery materials, and then ultimately picking up those batteries and starting the whole cycle again. I'll tell you today a little bit about the battery division and the recycling division. Next slide, please. And here's the team that provides the expertise behind all of that. A lot of grey hair or no hair, a huge amount of experience in the chemical industry and the mining industry. Next, please. I'll talk firstly about the battery division, and that's centred firmly around lithium ferrophosphate, LFP, that contains no nickel and no cobalt, and is the fastest growing sector of the battery industry. In fact, if you go back only a couple of years, it was about 10% of the battery industry, and today it's over 50. Next slide. And this is the growth rate of LFP, and it has been to a large extent a China-centric product, but the market is growing so rapidly that everything that's produced inside China, I think the video says 98% is produced inside China. Well, the market is growing so fast, it's now 99.5% produced inside China, a very small proportion produced outside China, but the growth rate is very, very fast. And we're seeing a transition from nickel and cobalt batteries to LFP on ethical grounds, cost grounds and safety grounds. And you've only got to look at companies like Tesla that have gone from 100% nickel and cobalt based batteries to now 50% LFP, and all the other EV manufacturers are following. But a phenomenal growth rate. And I think what the market needs to do is develop alternative supply chains that don't go through China. And the reason behind that is simple, in that there's very little manufacturing capacity outside China. There's a big demand for the product, or the end product, as LFP batteries, and there's no one producing the active material that needs to go into those batteries. So we see the emerging markets for LFP being just about any country that produces batteries outside China, primarily Europe and North America. Next slide, please. So what's it all about? If you compare the battery chemistries, there are a number of them there. The numbers on the right-hand side in that little panel are the ratios of nickel, manganese and cobalt. So you've got NCM 622, which is the most common EV battery. It does suffer from some performance problems and cost problems. And then you go through the rest of the nickel and cobalt batteries. Place you don't want to be on that spider diagram, by the way, is in the middle. So best properties on the outside, worst properties on the inside. And as you morph the chemistry and take more of the cobalt out, everything becomes a compromise. But if you have a look at the lithium ferrophosphate LFP, it exceeds the performance of most of the other chemistries in every department apart from one, and that's energy density. That can be fixed by different battery architecture and slightly changing the chemistry. Next. So where do we do this? We do most of this in Brisbane pilot plant that we've had. It's been in operation now for 20 years. Most of the time devoted to LFP. It's developed a very simplistic flow sheet, very, very effective, great from an environmental point of view because there are no recirculating loads. There are no waste products, liquid or solid, to discharge, and it produces a consistent product day in, day out. So it runs rings around most of the other processes that have been developed inside China. And we believe this is the answer to quality control and the ability to provide a product that has very high ESG credentials. Next. I'll now move on to EnviroStream. EnviroStream is the only fully licensed lithium-ion battery recycler in Australia. We own 100% of that company. It's got a number of divisions. It's got 2 operating plants in Melbourne. It's got a diverse collection network around Australia, collects the batteries, sorts the batteries, separates the materials, and those materials go back into the battery industry or other scrap metal industries. We recover all the scrap plastic, we recover aluminium, we recover copper, we recover the nickel, cobalt and lithium from those batteries. At the moment, the market is too small in Australia to justify the capital expenditure in downstream refining. So some of the active materials, being the nickel and cobalt and lithium materials, get refined in Australia, but most of that is now done in South Korea. Next, please. You can see here, it's a little bit old, the data, but it certainly serves to prove the point, in that on the left-hand side, we've got batteries coming into service, the right-hand side coming out of service. There's a lag there of around about 8 years, which is effectively the average life of the battery. And this is pretty important, particularly with respect to the EV industry, in that the EV industry's producing product that the consumer is consuming today. We don't expect to see those batteries for a number of years, apart from warranty recalls and accidents and that sort of thing. But what that means is within a short period of time, we're going to have to be catering for the recycling of millions of tonnes of these things, and that's going to grow very rapidly. In Australia, we've got an interesting situation in that the Australian battery industry has entered into a stewardship scheme which effectively charges a levy at the point of purchase of the battery. That money goes back to the Stewardship Council and ultimately goes to the accredited collectors, sorters and recyclers of that material. We own a large proportion of that supply chain. I'm glad to say that the stewardship scheme now introduced is starting to fund those activities, and we are getting cash flow out of that. And of course, by doing that, the stewardship scheme effectively commoditises waste batteries, which means they have an assigned value and prevents them from going to landfill. So the volumes available for recycling are increasing also. Next, please. Move on to the next one. So what's the business all about? It's about creating a circular economy. It's about developing the appropriate technologies that make that circular economy work, and to a large extent producing the shortest route from mine gate through to motor vehicle. The industry is littered with processes that were designed not for purpose, legacy processes, and as a consequence, it really does have too many process steps in it. We've endeavoured to get rid of as many of those as we possibly can, and then cover those technologies with international patents. We're positioned well with respect to future demand for batteries and the recycling of those batteries, and we have a very active and successful team driving this forward. I should say that our view on the LFP market is it's not only going to be driven by safety and cost, it's also going to be driven to a large extent by legislation. If you look at emissions legislation, it's going to be introduced into Europe. That'll have a big impact on the battery industry, and ESG legislation is going to be introduced, which includes provisions for upstreaming and downstreaming all the ESG provisions. And as a consequence, anyone that produces batteries in Europe will have to be responsible for the entire supply chain. The days of Australia producing lithium concentrates, shipping those to China to produce a lithium chemical, and then into Europe or North America or wherever it may be to make a lithium-ion battery are just about gone. And we've got to change those supply chains. We've got to reduce the number of process steps. We've got to reduce the carbon footprint, and we've got to make sure that we can comply with all of the best ESG requirements available. Next, please. So that's the Lithium Australia story. We are the only company listed on the ASX that has direct exposure to the most rapidly growing part of the battery industry, LFP, and we do provide a complete ESG solution for energy storage. Thank you.
Thanks, Adrian. A really interesting story. You've obviously a little bit ahead of your time, given you've had a factory in production for 20 years in a pilot form. Can you explain why it's kind of hasn't progressed out of that pilot level?
Oh, certainly. It's a great question because it is progressing out of the pilot level. And I certainly should have mentioned that we're currently going through a feasibility study to do a couple of things. The first one that'll drop out of the feasibility study fairly early in the piece is for the development of a so-called pre-qualification plant to meet the requirements of the EV industry, which are quite stringent from a quality control point of view. And that plant will be scale at somewhere between 250 and 500 tonnes per annum. And the way you do the pre-qualification is initially you start off with small samples that go out to battery producers. And I've got to say, we do that on a regular basis, and we're testing in 8 countries around the world presently. Then they'll ask for larger samples and larger samples and larger samples to the point where your pilot plant can no longer produce them and you need a larger plant. So that's the first thing that drops out of that feasibility study, and that'll be the design parameters for the pre-qualification plant. And that'll be complete hopefully by the end of the year. The rest of the feasibility will cover a commercial scale plant to supply sufficient material for full production runs on a regular basis. And the scale of that'll be about 10,000 tonnes per annum LFP powder. Location, our preferred location is North America. At the moment, North America has 8 plants on the drawing boards that will produce LFP batteries, and they don't have a single plant that produces LFP powder required for those batteries. Bit of a gap in the market, and particularly with Biden's battery blueprint that says within a short period of time, all of that supply chain within North America, or the United States in particular, producing lithium-ion batteries is going to have to be domestic. So you won't be able to take LFP powder out of China. So I mentioned the effect, the impact that European legislation is going to have on the industry, and the US battery policy will have a similar effect. So different reasoning, but they'll all have the same impact. And it really means you've got to shorten those supply chains and start producing this stuff domestically. You can't take it out of China.
No, that's certainly a theme that's pretty well understood by the market at the moment. So as a producer of LFP, when do you get to that kind of offtake stage, and what sort of interest have you seen recently, given this LFP interest in particular?
Oh, look, we've had an enormous amount of interest out of China and Japan, and I've got to say we've been producing commercial format cells with our LFP in those two countries for a number of years. So there are relationships that are existing that could get to the commercialisation point very, very quickly. With a strain between Australia and China, perhaps our relationships in China aren't quite as valuable as they used to be, and we will have to concentrate on those other emerging markets, which are the emerging markets, of course, are any country outside China for LFP. So we think the United States is the place to be, and we think we're going to be in a position to be providing material in commercial quantities out of that 10,000 tonne per annum plant in about 3 years' time.
And you've got some investment in listed equities. What's the strategy around these? Are they the source of lithium, or are they a source of capital in the future?
Oh, no, it's intended to be the source of lithium. Well, not only lithium, you know, there are other battery materials and precious metals and base metals in that package. We effectively farmed out most of our raw materials division, and it sits in a number of companies, listed public companies, primarily Galan Lithium and Charger Metals. I think if you look at the way the battery industry is going at the moment, assured supply is becoming a major difficulty, and you've got companies such as Tesla investing fairly heavily in the supply chain from mine level right through to motor vehicle to make sure that they've got secure supply. The arrangements that we've got with the companies mentioned, and I'll tell you what, there are a couple of really good lithium projects in there, and the arrangements that we've got leave us with a 25 to 30% free carried interest in the projects. So when it comes to producing lithium chemicals in the future, subject to the exploration success of those companies, we will have access to that material. So we will then be able to go from resource through to the production of lithium chemicals, for which we have international patents, into the cathode powder, for which we have international patents, and then sell that cathode powder into the battery industry. Pick it up at the end of the day, of course, recycling that material when it's gone past its use-by date.
And Adrian, as you know, with respect, I was looking at the sector. Lithium, we know well, there's been some strong performance. Your share price is weak into what is a very strong environment. What are the concerns here for shareholders, and what's the market missing?
Look, there are a number of aspects, but I think if your primary focus happens to be the battery end, which ours clearly is, and it's the production of LFP, lithium is a cost rather than a revenue. So the high lithium price is somewhat detrimental to the production of that material. The cathode powder price has been rising pretty fast, but they haven't risen quite as quickly as the price of lithium. But I think if you look at the battery materials then across the board, and you look at the compositions that contain nickel and cobalt, the cost of producing those has just gone through the roof, because the cobalt's gone up, the nickel's gone up, and the lithium's gone up. They've all gone up simultaneously. The rate at which the cost of producing an LFP battery goes up is about 25% of that of a nickel and cobalt battery. But I certainly have a view on the lithium price, and I think the lithium price is unsustainable at current levels. And of course, all you see published really is a spot price Most of the market trades on something like 3-year contracts. And if you go back and look at the median of those 3-year contracts, it's not the $70,000, $80,000 a tonne. It's more like 15, 16. But the number that gets reported is that very high number. We're going to see a bit of demand destruction as a consequence of COVID and plants closing in China, which will be a restriction on the supply chain. And that will, to some extent, decrease lithium demand a little bit. And then I can see pricing coming back to more rational levels, which will be something like the median contract price at the moment. Then hopefully all of the hysteria about the spot price will disappear.
And Adrian, just to finish up, your battery recycling business is a global business, effectively. There's no battery manufacturing in Australia. So how do you get a foothold in key regions like Europe, for example?
Well, no, we're not quite global yet. We are looking at, the UK in particular. They're not part of Europe anymore, and having a look at the United States. But at the moment, all of our product is, it's not all sourced in Australia, but the majority of it comes from Australia. We get a bit out of New Zealand, a bit out of the Pacific Islands, some out of the Philippines, but it's primarily Australian. And to maintain that business, quite frankly, the majority of the expertise is not the technology, it's how you run the collection network. And we have arrangements with a number of the EV producers, a number of the large companies producing energy storage products, certainly LG, Bunnings, Officeworks, all of those I can name. Some of them are confidential agreements that we can't name the counterparties on, but a lot of large players there, and they're pushed in that direction by the consumer. The consumer's sick of seeing things going into landfill, and those lithium-ion batteries have some pretty horrible stuff in them and should never go to landfill. So yeah, it's all about the collection network. I always say that if you want to have a successful business in recycling batteries, the 3 key ingredients are where you've got a stewardship scheme that helps fund the collection. So, that's an environmental issue for governments and the public at large. We've got that in Australia. Where you've got no competition, we are the only fully permitted lithium-ion battery recycler in Australia. Tick for that one. And where you've got plenty of batteries. So where do those other environments or jurisdictions sit? I can't tell you, because you'll go and do the same thing. But believe me, there are other places around the world that have those 3 key ingredients, and we've got them under the microscope, and they will be the next expansion that we see offshore.
Great, Adrian. That's all we have time for. Thanks for your time. Have a nice weekend.
Thanks very much, Tim.
That's all we have time for, everyone. We'll see you again next week. Some new companies presenting and some exciting products that may be listing very shortly. So we'll see you then.